Exercise 816, Part 2. This is probably the bigger pain in the butt of the two parts of the problem. And it starts out with the tougher ones and ends up with the easier ones. So let's get started. The depreciation expense, they tell us that the company bought this asset, what was it? I forget, they have it listed, just equipment for $15,000. They estimate that it'll have a residual value of $3,000 and that it will last for 24 months. That's their estimate. So $12,000 is the total depreciation. Divide that by 24, $500 per month is what we determined is the depreciation expense. So depreciation expense, 500, accumulated depreciation, 500. The next is bad debt expense. This one's the pain in the butt because you have to go back and take the beginning accounts receivable, which was $46,200, which I can't even write down, obviously. Sorry about that. $46,200. Then you have to add the sales and subtract the payments. So first we have to add to that $135,000 for the first set of sales. That was on January 15th. And then we collected $125,400. So we subtract that $125,400. And then we wrote off accounts receivable of $4,800, so we have to subtract that. And then what else did we do? Then we sold some more stuff, right? Yeah, $132,000 we sold on accounts. The other 11 was cash. We don't need to worry about the cash for this part. And then what else happened? So that gives us what we need altogether. And they're saying something here about $11,000. And that's the cash. Okay, so we don't need to worry about that. So we have to add that together. We add all of those together. And I'm going to do that right now, because I am clearly not going to try to do that in my head. We both know that that would be ugly. So we have $46,200 plus $135,000 minus $125,400 minus $4,800 plus $132,000. Whoops, forgot a zero. And that gives us $183,000. And then they tell us that they believe that at the end of January, $11,000 are past due, and the company estimates that 30% of those will not be collected. So this gives us 183 minus the 11, because they tell us we have to handle those separately, because 30% of those will go uncollected. That gives us 172,000, and of the 172,000, they tell us that 5% of that will not be collected. So we had to do this, although there's 183,000 in accounts receivable, 11,000 of it is old, so 30% of that's going to be uncollected, and the remaining 172 is what will be considered for the 5% uncollectible. So when we do that, we have to take the 30% of 11,000. So 11,000 times 30%. So that's 3,300 that we're not going to collect. Plus 5% of 172,000. 172, 1, 2, 3, make sure I get my zeros, times 0.05, 5%. That's 8,600. So I expect not to collect 11,900 altogether. And then they tell us that we had how much in there? We had in the beginning trial balance, and you have to think through this step by step, piece by piece. In the beginning trial balance, we had $4,200 put aside in our allowance for doubtful accounts. It's right in there. We had $4,200 credit balance. Well, we wrote off $4,800. So that leaves us a $600 debit balance. We need to add that because they tell us they're looking at uncollectible accounts. This is the balance sheet approach. So you have to add that. So our bad debt expense for this year is $12,500. I got to admit that's the ugliest accounting problem I've ever seen. But it's also pretty real life. So we have to handle this. And that's our bad debt expense is $12,500. And our allowance for doubtful accounts is $12,500. After you've done that, the rest of this problem is duck soup. Okay, because that one is just stone cold ugly. Then January 31st, we have interest expense, and they tell us that we had borrowed, or we owe what, $50,000. So we have $50,000 times 6% times 1/12. So it's $50,000 times 6% times 1/12, because it's just for that month, because we're doing the adjusting entries for the end of January, so that tells us that they do this monthly. So when you work out that number, that comes to $250. And then it asks us to take a look at, or it gives us some additional information. It tells us that we have income tax expense of, where the hell is it? I know it's down there. Accrued income taxes by the end of January are $13,000. So that's a $13,000 debit tax expense and a $13,000 credit to interest tax payable, or income tax payable, income tax payable. And then last but not least, and by the time you've gotten here, you're pretty well wrung out. We have some deferred revenue, some unearned revenue that we earned. $3,000 of the gift cards were indeed used, so we're going to debit the unearned revenue for $3,000 and credit the earned revenue for $3,000. Bit of a pain in the butt, but you had to work through it step by step, and it wasn't too bad. Admittedly, the middle part with the allowance for doubtful accounts was kind of ugly, but if you work through that piece by piece, line by line, it wasn't so bad.